We're talking about e-commerce tax. My name is Raphael McFarland. Just give you a quick outline of what I'm talking about. E-commerce tax, ways it impacts business and sole proprietors, and the e-commerce tax and the forms that do and the legal stuff that goes along with it. So, as we know, e-commerce deals with selling products online, and pretty much businesses only require sales taxes in states that have a nexus, pretty much a physical location within the state. For example, if you're running an e-commerce business from a home office in New Jersey, you will only charge sales tax to people who buy your stuff online who are from New Jersey. You wouldn't charge the other people from other states. Those people are supposed to like claim it from their taxes themselves and do that kind of stuff. The problem with that is most people don't write it on their taxes, and so the government loses a lot of money because they don't file their taxes properly when they buy stuff online. So it's a big, complicated process that everything goes through. In 2009, the government said it lost $23 billion of revenue just from sales taxes and people not filing it the correct way. And in Texas in 2009, said Texas alone lost $600 million from sales taxes, pretty much the same thing. So it's a lot of money that companies lose by not having people like just do it correctly on your taxes. And it's hard because each state has their own rules. Not all state has the same mandatory e-commerce tax. So Virginia and say like North Carolina are totally different. Even though they're next to each other, the states don't have like one unison mandatory law, which the government's kind of working on right now. And if they figure out how to come up with one unison like sales tax, e-commerce sales tax, then pretty much everything that you buy online is going to be like the prices are just going to raise because you're going to pay for like the shipping, the handling, the product itself, plus like state and local government taxes, plus like any other fees that comes with the business. In 2012, a new tax statute is coming out that requires PayPal's and other like payment services to report like the revenues and sales gross that people buy online, and they're going to report it on the 1099-K form. So pretty much anything you have to buy online, PayPal's going to have to record it and send it off to you guys. So like individual people are going to have to like report it themselves. And in Virginia, it's law that people who buy products online are supposed to remit taxes as part of their state income. So if you're not, it's basically saying like if you're not charged for sales tax, you're supposed to like do it yourself and put on your own like income tax, which is kind of crazy. It's kind of like a lot of people don't do it. Most people don't know about it, that it's a law in Virginia, but it actually is that you're supposed to like everything you buy is supposed to have your own taxes. And that an easiest way for a business to like help themselves not get caught by the government for this kind of problem is to have an automatic software program that automatically calculates taxes and figures everything out themselves. That way the government won't get on their case, but the software will like automatically do it. That way when you pay on the checkout stuff, you'll pay for the product and you'll do all the taxes then and there. That will save everyone problems. And pretty much how this impacts your business is that it's going to need additional software. You're going to need to automate tax calculations, just like I just said. It's going to push for more paperwork. You're going to have to pretty much keep documents of all like transactions you do, everything you do. A lot of programs will give you like an online database and like different Excel spreadsheets, and they'll just like send it to you during tax times. That way, it'll keep track of like everything you have to do, all your taxes and all your forms. And another thing how it impacts your business is you're not going to be able to position your product on price. You can't do this because you're going to have the people buy the product plus additional fees for taxes, which you can't tell people that's a cheap book or a cheap product when it's really not, because they have additional fees. You're gonna have smaller profit margins just because like the new taxes. So when you sell a cheap product and the taxes and the fees are all raised, then you're gonna have like less profit, less margins to grow there. So people are gonna have to figure out and compensate for those the charges, because you don't want to raise your prices too much to overdo it, but you have to figure out like how to balance that out. So I basically just talked about like how e-commerce taxes are affected by business, and our class picked to have a sole proprietor type of business for our book that we're doing. Now I'm just going to inform you about the sole proprietor and how it deals with the e-commerce tax and the different laws and the tax forms that go around with it. Real quick, I'm just going to say some of the advantages of the sole proprietor for the reason that our class came up with it. And the main reason was it's easy to create and very low cost. The sole proprietor is like the easy to come up with. There's one person in charge and they deal with everything. You have no business formalities and no company bylaws that you have to worry about. You don't need to pay any unemployment taxes, and the person who owns the business, the sole proprietor, he doesn't have to have separate bank accounts for the business or for him personal self. Like it could be one big bank account. So that's pretty much so technically Dr. Gertis, the professor, he could do that. He could have one big bank account and it would be no issue with the government or no issue like that. The good thing is that if any losses from the businesses, it could help, and you just take out your personal income tax. So this could help our professor out. If our book fails, you can just kind of write it off on his personal taxes. So that's the advantage of that. And a disadvantage is for sole proprietor is that the person in charge is liable for everything. So if the book just like fails, everything that we put into it, all the money and everything, we just kind of lost. We don't get it back. We can't get any help from anyone else. And if we spend all our money up, we can't like sell shares of stock. We can't do anything to help our business like collect revenues or anything like that. So that's pretty much a disadvantage for that. Pretty much, since our company is set up as a sole proprietor, any revenues that you earn, well, you have to put on the 1040, which is like the personal tax form. And the IRS looks at it not like a business. You can't tax the business, but it'll tax the business assets, I guess, for the sole proprietor. Like that's how it works. Then when you're doing your taxes, you got to figure out which kind of tax you want to do. You can either do the Schedule C form, which is the profit or losses from business, or the Schedule C Easy, which is the net profits from business. They're pretty much the same thing. It's just a little bit difference here and there. But those are the two main forms that sole proprietors have to worry about doing with their business. Everyone has to do the 1040, but they have to pick one of these to do, and they attach it together and send it in together for the IRS and for the company. And a sole proprietor also has to worry about the self-employment tax. That is a tax that if you make more than $400 a month, they have to pay this self-employment tax. So if our book sells more than $400 a year, not a month, $400 a year, then we'll have to pay this tax. Pretty much there's no separate tax rate on the sole proprietor. The tax rate for the sole proprietor depends on the owner and what their tax rate is. So the company won't be charged a different tax rate. It'll be the same tax rate as the owner.